very beginning of the year, we were in this three-part segment on my 25 questions for 2025. Look, I came up with 4 big macro questions, 1 question for each of the 11 major sectors, and, of course, 10 tech-specific questions. So now that the year's nearly over, let's talk about the answers. First question, does the yield on the 10-year Treasury go to 4% or 5% first, or neither? At the time, the 10-year was sitting at just over 4.5%. And this is one where we got a definitive answer because the 10-year went to 4% first. Given that so much wealth from housing to your portfolio is related to the 10-year, we have to follow it like a hawk. What happened in 2025? Specifically, the 10-year broke below 4% briefly in that post-Liberation Day washout last spring, setting a 52-week low of 3.88 in April. More recently, now that the Fed started cutting short-term interest rates, the 10-year has touched the 4% level a couple times, first in mid-September, then in mid-October, and then again in late November. Of course, the bulls would feel better if the 10-year had fallen below 4% and stayed there. But that's not the case, with the benchmark yield currently sitting at about 4.15%. Don't let anyone scare you. That's fine. Fine for stocks. And there's a lack of consensus about how much help we can realistically expect from the Federal Reserve next year. Not even the members of the Open Market Committee can agree on the number of rate cuts that are needed. Say nothing about investors or people betting in the predictions market. The second question for 2025, we wanted to know whether the labor market would remain tight. And here the answer seemed to be a definitive no. We went from adding over 100,000 jobs per month in the first few months of the year to averaging around 17,000 jobs added over the course of the past 6 months, meaning June through November. That's actually kind of pathetic. In June, August, and October, job growth was actually negative. And that, I'm going to call that bad. Meanwhile, the unemployment rates rise from 4% in January to 4.6% in November. That's not good either. Now, the silver lining here is the fact that the labor market weakness has allowed the Fed to remain our friend. But to answer the question from the beginning of the year, no, the labor market has not remained tight.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.